Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're excited to have you join us today. As we begin, let's talk about one of the most successful investors in history, Warren Buffett. A recent story caught our attention, highlighting his investment philosophy and how it has contributed to his success. Buffett's approach is centered around staying within his circle of competence, meaning he focuses on industries and companies that he thoroughly understands. One notable example is his investment in Wrigley, the chewing gum giant. In 2008, Buffett invested $6.5 billion in Wrigley, and it paid off handsomely. He also has a long-standing fondness for Coca-Cola, a brand that has been around since 1886. Berkshire Hathaway, Buffett's investment firm, holds 400 million shares of Coca-Cola, valued at $26 billion. Buffett's philosophy is not just about picking winning companies. He's also a strong advocate for investing in an S&P 500 index fund. He believes this approach provides diversified exposure to 500 of America's largest companies across various industries without the need for constant monitoring or active trading. This strategy is accessible to anyone, regardless of wealth. With the rise of trading apps like Public and Robinhood, investors can now capitalize on the stock market with minimal investment. These platforms offer fractional shares, zero commissions, and even free stocks for new customers. It's essential to remember that investing always involves risk, and it's crucial to do your research and consider your own financial goals and risk tolerance before making any investment decisions. We'll continue to explore the world of finance and provide you with insights and analysis to help you navigate the markets. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of healthcare, where the dynamics are constantly shifting. Today, we've got two stories that caught our attention, and we'll be exploring them in depth. First off, let's take a look at the improving breadth in the healthcare sector. According to a report from Barchart, individual stocks within this space are starting to outperform the index, supported by demographics, employment growth, and steady capital deployment. This quiet yet consistent performance is exactly what traders and investors should be paying attention to. One stock that's making waves is UnitedHealth Group. Despite facing fierce criticism over its healthcare and insurance practices, the company has vowed to be a better corporate citizen amid layoffs. In fact, they've just released the first round of results from an independent audit, outlining 23 action plans aimed at enhancing transparency and policy governance. Now, it's essential to approach this story with a balanced perspective. While UnitedHealth Group is taking steps towards improvement, the company still faces significant backlash over allegations of costly insurance, overbilling, and denial of necessary care. As investors, we must consider both the potential for growth and the risks associated with regulatory scrutiny. On the technical side, our friends at Barchart have identified a classic three-candle drop reversal setup in AHR's chart, which could indicate a potential breakout above 48.50. If this level is cleared, we might see a measured upside target closer to 55. However, it's crucial to remember that technical analysis is just one piece of the puzzle, and fundamental factors will ultimately drive long-term performance. As we navigate these complex stories, it's essential to stay informed and adapt to changing market conditions. Whether you're a seasoned investor or just starting out, understanding the intricacies of the healthcare sector can help you make more informed decisions. Welcome back to the Riskwiser Zone. Today, we're going to explore a thought-provoking story that highlights the financial struggles of a couple in their 70s. The husband, 76, is still working, and they have a modest $100,000 in savings. While it may not seem like a lot, this amount is actually higher than what many Americans have saved for retirement. The couple's situation raises important questions about financial security, lifestyle, and the importance of making the most of what you have. As we discuss their story, it's essential to remember that everyone's financial journey is unique, and there's no one-size-fits-all solution. One key takeaway from this story is the importance of preserving capital, especially in retirement. With a limited amount of savings, it's crucial to make smart investment decisions that balance risk and potential returns. A conservative mix of stocks, bonds, and cash can help ensure that their savings last throughout their retirement. It's also worth noting that financial insecurity is not a competitive sport. While it's natural to compare ourselves to others, it's essential to focus on our own financial goals and priorities. As one Facebook group member pointed out, having $100,000 in savings puts this couple ahead of many Americans. Ultimately, this story serves as a reminder that financial resilience is just as important as financial resources. By being mindful of their expenses, making smart investment decisions, and adapting to changing circumstances, this couple can make the most of their retirement savings. As we conclude today's episode, I want to leave you with some food for thought. Regardless of your financial situation, it's essential to be proactive, flexible, and informed. By taking control of your finances and making informed decisions, you can reduce your risk exposure and achieve your long-term goals. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.